Good evening, everyone. This is Wayne, and this is the video version of the trade report for Monday, April 2nd, 2018. Well, the first quarter has come to an end, and the second quarter has just begun, and it began with a bang. Stay tuned to find out more. Greetings, everyone. Hope everyone had a good 3-day weekend, and thank you very much for spending part of your Monday today with me as I go over the action and events in the financial markets. Let's start off, as we usually do, with the S&P futures. This is a 15-minute chart of the S&P futures that includes not only the regular session of the S&P futures, but also the extended session as well. Let's just do a little bit of recap, bring us back up to where we are today. As you recall, Thursday's action was kind of relief bringing, I guess is the best way to put it, after Monday's huge push to the upside and Tuesday's collapse and Wednesday's back and forth chop and slop session. We ended the quarter, the month, the week, the shortened holiday week on an up note. We actually went a bit higher and came a little bit down into the close, which was fine. It was kind of a technical drop into the close because we had the DPOC, or the developing point of control, right here that price dutifully fell down to. So when the markets opened, shall I say reopened, again yesterday, which was Sunday, a full 72 hours after the markets closed on Thursday, there was a little bit of sideways action that pretty much took the entire extended session to play out. You can see how we had extremely consolidated price action, which would lead one to believe that the second quarter trading may open with a little bit more relaxed price action. But as we've come to know, the extended session, the pre-market, doesn't really give us a good indication of what the regular session is going to be like. And that is precisely the dynamic that played out today. So with an otherwise relaxed, consolidated bit of price action in the overnight session last night, and let me just be very clear really quick, I call the extended session, the overnight session, and the pre-market session, and it's virtually all the same thing. Pre-market is that period of time between when I wake up, so it's a little bit on the subjective side, and the time the regular market session opens, which is a period of approximately between 2 and 3 hours. The extended session is the session that trades after the regular session closes. And so technically on Thursday, there really wasn't an extended session. But then there's an overnight session, which is, for all intents and purposes, the extended session, as I said, as well as the pre-market. So it's, when I say pre-market, extended session, overnight session, I'm kind of talking about all the same thing, but just utilizing different vernacular for the purpose of giving you the information that I'm trying to provide. So when the pre-market gave way to the regular session today, there was a little bit of a move to the upside, which got traders kind of feeling good about the possibilities for the day. But immediately, the market just completely gave it up. I mean, this market just literally was dedicated to the downside from the first after the first 15-minute bar. So there was a 15-minute point in time when traders were given hope, and then the market basically just said, not today. And from the standpoint of why this happened, Chinese tariffs are being blamed for this. So apparently China came out with a list of, I think it was 128 different tariffs that was in response to the tariffs that we are going to be implementing. So, again, there's some gamesmanship here. There's still some unknown about how this is all going to play out. But the interesting thing is this was expected. So for the market to really go deep down was not something that really anyone saw coming. Now we still do have the technical dynamic of needing to retest the February lows. I know I sound like a broken record, but this is a very important technical component of what it is we need to deal with. Now, here's where there's a rather significant issue that exists as it relates to that. We closed the regular session today below the 200 period moving average. That is a huge sell signal in the market. Now, I am not telling you that we are just destined to continue down. That being said, the probabilities are in that camp. Technicians and those who follow the technical analysis component of the financial markets are looking at the S&P today and kind of shaking their head and not exactly sure what's going to happen. Now, we did have a decent up move from the low of the day into the close, but we still didn't close above the 200 period moving average. So again, from a strictly technical standpoint, that is a sell signal. That does not bode well for the bulls. And the bears basically let the bulls push this market back to the upside today. Now that does a couple of things. It gives the bulls some hope, but it also provides a market level that is much more desirable for the bears to once again begin shorting the market. So we've got this duality that exists, and once again, we're in the extended session. Now, right now, the market's closed. The extended session's closed. It will be closed for, pardon me, it'll be closed for about another 45 minutes. There's a 1 hour period of time where the transition between the two days of futures trading needs to go through transition and settlement. And that's where we're at right now. It's approximately 2:15 Monday afternoon on the Pacific Coast, 5:15 on the East Coast. So at any rate, there's nothing happening in the S&P futures or any of the other index futures right now. So again, the technical aspect of this market is one that is being watched extremely close as a result of the close today. Now, I do want to bring this to a daily chart because there's something very important here that provides a little bit more hope, if you will, for the bulls. And this is the Fibonacci's. So what I've done is I've taken the most recent swing low to swing high that provides me with a measurement that I can take some Fibonacci readings from. And that would be this low to this high. Now, we do have a low to high here, and that will be a secondary, and I would say minor level to take a reading from if I needed to do that for additional clarification, which in my opinion, the way that I read the Fibonacci's, I do not need to do that. So what I'm looking at here is a couple of different things. Obviously, the market has fallen. It's gotten back up again. It's fallen. It's gotten back up again. And now it's falling again. But what is happening is we have a 1272 target and a 1618 target that have both been respected. Now the 1272 is a first level target. Once price moves through the 100% symmetry support on a retracement measurement, then the 1272 becomes a target. Now there is support there, but it's more of a draw for price than it is a resistance level for price. That being said, there is resistance there. So you can see where the market did push down. It closed below the 1272, but then it popped right back up again, actually closed above the 100% symmetry support line. And then the next day, it came back down below the 1272, but then closed above it. The following day, which was last Wednesday, it went below it and closed above it. And then, of course, on Thursday, we went higher, went above the 100% again, and then closed below it. So we've had this back and forth, just this kind of rocking between levels here that has been, respecting the Fibonacci levels. Well, today we also had a Fibonacci level respected, even in light of how far we fell. And that Fibonacci level was the 1618. And that 1618 is a secondary target. Once price comes to or close to a secondary target, more often than not, it bounces up off of that. It reverses, it goes the other direction. It's almost as if it's completed a cycle. Now, there is a lot of bearish sentiment in this market. And I am in no way, shape, or form predicting that we're done going down, because we have closed below the 200 period moving average, as I said, and we have not tested the 200 period, it's not 200 period, excuse me, the February lows. So even though we have closed below the 200 period moving average, we have not tested the February lows. But from a bullish perspective, we have basically bounced up off of the 1618. Now, we could go through another one of these cycles where we have 4 or 5 days of back and forth. We could go like this, up and down, up and down, up and down. I don't know what's going to happen, honestly. We had a huge down day today, and there's a lot of momentum to the downside. And there are varying opinions on what is going to happen next. So, we're in a remain to be seen kind of environment. But if I am to look at this market, this S&P market, as well as the NASDAQ, as well as the Dow, as well as the Russell, and be purely objective about what I'm seeing, I have to provide an outlook that says the bears have the high probability trade here. This market looks like it still wants, and potentially from a technical standpoint, needs to go down. Now, that doesn't mean we're going to go down tomorrow. We could have a big bounce tomorrow. That's the kind of action endemic to this market. This market has big moves in both directions. Today, the Dow lost 458 points. It was down over 700 points at one time. So it came back over 200 points. The S&P dropped 59 points. The NASDAQ had a really rough day, down 193 points. And the Russell ended the day down just under 37 points. Just a very big down day overall. So one of the stocks, obviously, that I follow very closely and want to show you is Amazon. Amazon was probably the worst performing stock in the stock market today. Again, President Trump came out and started talking trash about Amazon and how it takes advantage of the post office and doesn't pay enough tax. And it's, in my opinion, it's really manipulative. And that's being really euphemistic. Anyway, so you can see I've got the same levels drawn on the Amazon chart. I've got the 100%, the 1272, the 1618, and you can see again how over the last 3 sessions, the 1272 and the 1618 have really come into play. So last Wednesday, that's the day that the first Trump tweet came out, and Amazon collapsed and then really recovered nicely. And I told you I bought some Amazon, right about here. And then the next day, Amazon had a really rough, start to the day, went lower, and then ultimately closed higher on the day. But then today, another Trump tweet and some market problems contributed to a very big down day in Amazon. and Amazon ended the day 75 points lower. It was over 85 points lower at one time. So it came up off its lows as indicated by this candle here. But just like the S&P futures, you can see where the 1618 has really been respected here. In fact, the low on the day in Amazon was 1355. The 1618 is 1355.64. So it respected it and only went over that level by 64 cents. So this is another clue. The market is continually giving us clues about what it's going to do. Not necessarily how it's going to do it or when it's going to do it, but when we use Fibonacci's and when we utilize market profile and when we utilize the Ichimoku cloud indicators, we can come up with a relatively decent thesis of what to expect short-term and long-term out of stocks as well as the market in general. So what I'm looking for is continued downside pressure, but that doesn't mean continued selling. I know that sounds a little bit counterintuitive, but a market can have a lot of downside pressure and still move higher. The emphasis on a market will make the decision of how far in a contrary move it will actually go until that contrary move becomes the new emphasis for the market, if it becomes the new emphasis for the market. Which brings me to another point, and that is we're on the cusp of earnings season right now. Earnings season is kind of like the circus coming to town. It's the big show. Analysts are coming out, they're making their projections for price targets for stocks. They're saying stocks are buys, holds, sells, outperforms, underperforms, market performs. There's a number of different analysts' evaluations that do tend to drive price in earnings season. So right now, we're, like I said, right on the cusp of earnings season. So there is going to be a lot of criteria and a lot of stimuli to make this market do some things that may or may not be conducive to what traders think should or could occur based on the usual and customary factors and metrics that markets trade on. So because it's earnings season, there's typically some optimism associated with that. And that optimism oftentimes will lead to kind of an inflated or false expectation of higher prices. So we'll have to see how that all plays out. But today was kind of a reality check. First day of the quarter, and the market really just took a toll on anyone who was long. And I mean, I've got some long positions, but I'm also nicely hedged. In fact, I actually exited one of my hedges today. And let me show you where I exited that. Right about here. I was working with one of my coaching clients today, and we'd been going a little sideways, and we were talking about how, reading the market and feeling the market and being able to deduce and assign value to the market from a bullish and or bearish perspective, and to make assessments as it relates to the direction the market's going to move next. And right here, I just knew the market was going to go higher. So, and again, I've mentioned this many times, but there's an intuitive dynamic associated with every trader, whether or not they want to admit it, whether or not they understand it, or whether or not they even want to go there. But suffice it to say, it's available if you want it, and that's part of what I teach with my coaching. But right about here, I said, oh man, the bulls are taking this thing over. And that was really an odd thing to have happen. You just kind of feel the sentiment shift in the market. So I exited one of my hedges here for a very nice profit. And of course, as you can see, the market did head higher. Now, I will tell you that I had a moment where I thought, you know, I may have been premature, and that's obviously on this candle here. And I believe that candle gave us a little bit of downside action, primarily because there was a technical analyst on CNBC today who made a rather blatant and phenomenal proclamation. He said, I think we'll probably retest the February lows. And, obviously I agreed with him and didn't think much of it. But then he said, the next level I see for this market or for the S&P is 1800. And I said, what? I mean, that's over 700 points lower. That's the equivalent of 7,000 Dow points. So I'm having a little bit of inability wrapping my brain around that. But you know, for every market participant that there is in this market, there's an opinion, there's an idea. Very rarely do market participants evaluate the market and arrive at a full-fledged trade thesis, which is another thing I teach in my coaching. But at the same time, you don't need a trade thesis to trade. In fact, you don't need anything but a computer, a trading platform, um, a few $1,000s, and you know, a desire to just get involved. But I don't recommend doing that. It's a recipe for disaster if you don't understand market metrics and the dynamics of trading in general. But at any rate, when I heard that 1800, I just kind of, it really took me aback. And that's when this candle began to form. And I thought, oh, great, because there are millions of people watching CNBC, so it becomes kind of a self-fulfilling prophecy. Everyone's hearing 1800, so they're going, oh my God, I've got to get out of this market. Well, then cooler heads prevailed, so to speak, and the original dynamic of the bulls kind of getting control right about here took over. And we went higher, and then we went higher, and we came down a little bit in the final 15, but then when the extended session opened, we went a little bit higher. So right now, I'm feeling I'm feeling okay about where I'm at as it relates to my positions. I still have one hedge trade on, and I'm glad I got out of it right here because that was a lot of points that I would have had to endure to the upside, which would have gone against my hedge and would not have benefited me for my other long positions. And just for the purpose of kind of getting a sense of where this is, let me just, so that was like, let's call it 2569 just for figuring sake. And the close was 2579. So that was over 10 points. So I was able to exit my hedge for a profit and then see the market move with what would have been against my hedge had I kept in it. So it becomes important to understand how to read the market, how to feel the market, and how to access the intuitive aspect of who you are as a trader and be able to utilize that and apply it to your trades. So, and it's not about being right or wrong. It's just about reading the market. It's about evaluation. It's about following your trading plan. So anyway, at this point, I'll be waiting for the market to reopen in about about a half hour now. Yeah, little over a half hour, and we'll see where the market goes. We'll see what it does. Obviously, I'll be tracking it, not trading it, tracking it in the overnight session, and tomorrow. Interesting. Will we bounce? Will we continue going lower? We've got an employment report this Friday, which is highly anticipated. I don't know if there'll be any more tariff talk tomorrow. If Trump will tweet again about Amazon, I don't know. But the Amazon's starting to look really attractive, folks. I will guarantee you that fund managers are just absolutely wringing their hands and licking their chops. We are on again, on the cusp of earnings season, Amazon is still the market leader. To have a market leader kind of giving it up like this without there being any real reason necessarily, I've seen this before. And this is a classic form of market manipulation that moves a stock price lower and provides an entry, a very, very desirable entry price for those who are savvy enough to recognize that it is a good entry. So we'll see how tomorrow plays out. Part of me thinks we're going to bounce, and the other part of me is dedicated to process. And I'm looking at this market saying it's weak. The bears have control. We haven't reached the February lows yet, and we have to get there. And if we do get there, will we go lower? The market has some significant weakness and bearish momentum associated with it. And as a result, the sentiment surrounding the market right now is bearish. And I have to respect that. But I know enough about bearish market conditions to know that a bear market bounce can be an absolute amazing move, very much like the one we had last Monday. So we'll see what happens. The VIX is the last thing I want to show you. We always like to look at the VIX. Volatility is the most important metric in the financial markets, so we need to make sure we're staying on track with that. And you can see how it's still kind of respecting that 1272. Fibonacci levels are magical. What can I say? I am so blessed to have been mentored by the Fibonacci Queen, and she imparted so much remarkable information and energy to me as it relates to the Fibonacci's. I mean, Carolyn, you're a rock star. So anyway, I've taken the Fibonacci's and applied my own dynamics and own methodologies, and I'm arriving at different energies of them all the time, and the way that I apply them is different than the way she does. But you have to have an entry somewhere, and to have the type of entry I had into learning Fibonacci's with Carolyn Broden, the Fibonacci Queen, I couldn't have asked for a better, more important approach at utilizing Fibonacci's. So the VIX closed basically right at the 1272. The closing print was 2362, and the 1272 is basically 2350. So 12 cents. So right now, the VIX is kind of respecting the 1272, and it actually hit the 1618 now that I take a closer look. The high on the day was 2572, and the high on the day was 2572, and the 1618 is 2578. So 6 cents. So again, these Fibonacci levels are important, and they're very portentous. That means, for all intents and purposes, predictive. And when we start talking about Fibonacci timing, that adds one more layer and level to the portent dynamic associated with Fibonacci's. So anyway, that's the VIX, and we'll see how tomorrow plays out, folks. And until tomorrow, trade safe, trade what you see. Good night, and good trading.